he sold the stocks, he got the gift from the parents, he's ready to buy his first house. So now Taylor has the funds to buy his first home with his wife. He's going out looking to buy a home. What does he need to know before he officially buys the home he's interested in? He's interested in knowing more details how having a home will reduce his taxes. So we talked about standard deduction versus itemized deduction. So that's an important part when it comes to owning a home, because when it comes to itemized deduction, the mortgage interest that you pay is under the itemized deduction. It's the tree, the apple tree, okay? So you remember we take the higher of the two. Okay, let's go through this this comic strip that I made. So I'm trying to make it more engaging when it comes to explaining this to clients, and you can share this with clients as well. So let's zoom in.
Standard deduction versus itemized deduction. We'll give you a standard basket of 15 apples in it, guaranteed. Or you can itemize your own apples and see if you're able to get more than 15. You'll get the higher one. Standard deduction or itemized. But you'll have to follow my rules. You can only take apples from trees that relate to your tax situation.
Because I paid state income tax and property tax, I can pick 5 apples. I have a mortgage as well, so I picked 9 apples. I also donated to charity and Goodwill. This allows me 4 apples. I didn't have any medical expenses, so no apples from this tree. I picked 18 apples. I'm going to itemize because it's more than 15 apples the IRS was giving me.
For this situation, we'll be itemizing 18 apples, which is 3 more than what the IRS gave.
So it's more beneficial to itemize in her situation because she's going to have more apples in that basket. Okay. Now, that's this example. There's another example for this guy. Same situation. You got to figure out standard deduction or itemized.
Standard deduction versus itemized deduction. We'll give you a standard basket of 15 apples in it, guaranteed. Or you can itemize your own apples and see if you're able to get more than 15. You'll get the higher one. Standard deduction or itemized. But you'll have to follow my rules. You can only take apples from trees that relate to your tax situation.
Let's see. I paid a little bit towards state income tax, so that's 1 apple. I don't have a mortgage, so no apples from this tree. I will donate to Goodwill, so this allows me 3 apples. I don't have any medical expenses, so no apples from this tree. I picked 4 apples. I'll take the standard 15 apples the IRS is giving me instead.
For this situation, we'll be taking the standard deduction of 15 apples.
4 versus 15, which one should he be taking? He's going to be taking the standard deduction because the IRS gave him 15 apples for free. Okay, so this is just my other way of trying to make this learning thing more interesting by doing a comic strip. So feel free to use this if you want. Now, interest paid is going to go towards itemized deduction totals. Okay, so if you get a loan to buy a house, so in this case, most people have to take a loan to buy a house, the interest that they pay on this loan is going to be deductible. But there's going to be some limits because of the TCJA, which is the Trump tax reform. For 24 and 25, before it expires, there will be some limits on how much mortgage interest that they can pay. And we have to let the clients know this because we got to set that expectation. Okay? So the way I like to say it is that interest on the first $750,000 of the loan is deductible. What does that mean? Pretty much, if the loan is $750,000 or less, everything is deductible. If the loan is $750,000 or more, then only the portion that reaches up to $750,000 is deductible. That excess amount of interest that they paid for the higher loan amount is not deductible. So I think there might be an example here to explain it a little bit clearer. So let's just say in this case, if the loan is over $750,000, what you do is take $750 divided by the loan balance, and that equals the deductible amount. Okay? And this is only for the next 2 years. We don't know what the Trump tax reform is going to look like in 2026, so just keep that in mind. Okay, so let's just say if the loan is $1 million and the interest paid was $40,000. So we take 750 divided by a million, that equals 75%. You apply the 75% to what the total interest was paid. Because remember, this 40,000 is being paid because he got a loan of $1 million, right? But because this loan is over $750,000, how much can he deduct in interest paid? 30,000? Yep, that is right. So it's $30,000, and it's that simple. So for clients who have a loan of less than $750,000, then it's going to be fully deductible, so whatever interest they pay. And then once it goes over $750,000, we have to do this whole calculation thing for the client. Okay. So now Taylor comes back and has a follow-up question. What about property taxes? How does this work into itemized deductions? So we know that when he buys a house, he has mortgage interest he has to pay, but also just because by owning a house, there is property taxes that he has to pay every year on it, okay? So again, this Trump tax reform, good for 24 and 25, will have limits on property taxes and state income taxes paid. So let's go over the details with that. So SALT. SALT stands for state and local income tax, or tax, okay? And when it comes to state and local income tax, the maximum they could deduct for this section on, they call it the Schedule A or itemized deduction, is $10,000 max, okay? So what is in this state and local income tax section? Property tax is one. What else? What? DMV is one. So DMVs is like when you register a car, you're supposed to, there's a little tax somewhere on there. You could deduct that. Anything else? Sales tax, we're going to get to that. What else? And state income tax. It's going to be, for most residents, going to be state income tax over sales tax. And we'll go over that a little later and how that works. But when you combine all those items, even if it's $50,000, the max you could take is only $10,000. Okay? So how do we explain this to clients? We got to make sure that clients understand that they can only do this $10,000 because in their mind, I have clients that actually pay like $20,000, $30,000 in property taxes, and they're under the impression that they could deduct all of it. Unfortunately, it's only $10,000, okay? But what makes it worse is that if they live in California and they have state income tax that they're paying through their W-2 and all that stuff, they already reached $10,000 just through state income tax alone already. So because of that, technically, none of their property tax is going to help them whatsoever. Okay, so we have to let clients know that property tax in that situation will not help them. Set the expectation so they know what to expect. Okay, so the way I like to say it, I say we combine these items right here: state income tax or sales tax, property tax for personal residents, local tax, which is very rare. I guess it's more for like other states that might have it, and then DMV tax. Okay. Now, after combining these, it's capped at $10,000. I want to go over state income tax and sales tax. So not all states have state income tax. So Texas, Washington, Florida, they don't have state income tax. So what the federal government says instead is that you can actually deduct sales tax. So sales tax is when you go and buy stuff and then they charge sales tax. It's a hassle to track because you're buying like $10 items here, there, $30 items. So trying to add all that, it's really more for big purchases like a car, or I had a client that bought an airplane, so he used sales tax, okay? And then, let's see. So that's the main thing for state. So when it comes to state income tax, or it's sales tax, it's not both, okay? So keep that in mind. So it's state income tax or sales tax, okay? So before the Trump tax reform, you could choose which one you want. So as a California resident, if for some reason they had a big purchase of like the plane, then even though they did pay state income tax, they paid more in sales tax at that time. Okay, so really important to know the difference. Most of the time it's going to be state income tax. So now Taylor understands the difference between itemizing and taking standard deduction. What else should I know about buying a home? So clients are always going to do these follow-up questions, so we've got to be prepared on how to answer these. So, okay, we talked about the mortgage interest. We talked about the property tax. What else should Taylor be aware of? What should we be advising him when it comes to buying a home itself? Buying a home, what can he deduct just for buying a home? Okay. So there's 3 things to know when it comes to buying a home. There's deductible in year of purchase, so pretty much what can you deduct now? What's added to basis, meaning that there are certain expenses where if you bought a home for $100,000, that's your basis, right? And then there's certain expenses that don't qualify for a deduction now, but instead you just add it on top of your basis. So you paid $100,000 and then you paid $5,000 for something, it gets added on top. So now your new basis is $105,000. Okay, and then what's not deductible and what's not added to basis at all. So pretty much no tax benefit whatsoever. So anyone can give me an example for either one of these? Home improvements, yes. Okay, good. Anything else? Anyone know what is deductible in the year of purchase? Okay, here's a list of everything that you could deduct in the year of purchase, what's added to basis, and what's not deductible whatsoever. Okay, so I know, Shar, you mentioned improvements. This will be talked about later, so we'll go through that. So it's not on this list, but it is correct in that it is added to basis. So here, deductible in year of purchase. So when you purchase a house in the United States, there's this thing called an escrow document, and it has a list of everything that you're paying. So there's a lot of fees when you buy a house, so many fees. So all these different fees right here that you're paying, this is just from buying a house right here, okay? And all these right here is just from buying a house, and there's more stuff over here that you're paying. And some of them are deductible, some of them are added to basis, some of them you can't do anything about, okay? So let's start with the year, what's deductible in the year of purchase. So taxes, I feel like it's kind of obvious. Like we talked about property taxes, that's the same thing. County taxes. Prorated interest. So this is where during the loan process or the home buying process, there's like a little timeline where you're paying interest, but you technically haven't moved in yet. Okay. And then, does anyone know what loan origination fee or loan discount is? No? What this is it's called points. And what the mortgage industry has is that, let's just say the regular mortgage interest rate is 6%. People could pay this thing, loan origination fees or loan discount called points. They could pay extra amounts to reduce that percentage from 7% to like 6% or 6.5%. So they, in a way, are kind of prepaying this interest, but they're doing it because they want to save, they want to reduce that interest rate as much as possible, okay? So when people are paying points on the year of purchase, then you could deduct the full amount on your tax return. Now, all these other costs like realtor fees, certifications, survey fees, those we have to keep track of. So we have to make sure that we hold the escrow documents for the clients, because this doesn't come into play until they sell the house. So if they sell the house 20 years, 30 years later, most of the documents are going to be lost, right? So we have to make sure we're keeping accurate records, because we want to take all these little fees and add it to basis, because by adding to basis, you reduce the gain as much as possible. You're bringing down the gain even more. So it's really important that we have all these little things, because over time, it adds up. If we keep track of everything here and what Shar said about improvements, all those things added to basis could save the clients like $10,000, $20,000 easily just by tracking these over the years, okay? And then all these other things like insurance, tax services, these are not deductible. So unfortunately, these are things that clients will have to pay and not get any tax benefit out of it. Taylor says, thank you for walking me through all this. Once I buy the house, I'm sure I'll have more questions. So good job. One of my biggest, I guess, how do I say, greatest feeling being an accountant is just receiving a simple thank you. Like that's my whole goal. Anytime I talk to a client and I try to gamify it. I treat it like a game. As like, my goal for this game is just to get a client to say thank you to me and I appreciate you. That's it. So I'll do anything, answer all the questions in as much detail as I need, answer in a way where I'm not rushing through it. I'm talking to them like they're just that one person I'm talking to, so making them feel important. So my goal is that I want to help them and I want them to say thank you to me.